Welcome to Delphos Insights. This is episode 34, where we examine agriculture, investment, and emerging markets in the 2026 tariff shock. So, imagine waking up tomorrow and you discover the cost of the single most important ingredient for your business just, nearly doubled overnight.
Right.
If you're a global farmer in 2026, that isn't hypothetical. Today, we're unpacking a massive institutional analysis on emerging markets agricultural tariff shock. Our mission is to figure out why this global supply chain crisis is actually creating a highly specific window for investors, basically fundamentally splitting the market into the exposed and the resilient.
And to really understand that split, you have to look at the spark that lit the fire. The catalyst here is twofold. You've got the 2026 tariff escalations and then the effective closure of the Strait of Hormuz.
Oh, wow. Yeah.
When those vital supply routes choked, input costs, the raw materials and fertilizers farmers need to grow literally anything, they just went absolutely ballistic.
Right, the numbers in the data are just wild.
Yeah.
The global benchmark for urea in Egypt, which is essentially the standard for nitrogen fertilizer, it jumps from $400 to $700 per metric ton.
In weeks.
Yeah, in just a few weeks, which is catastrophic if your entire business model relies on importing that one specific fertilizer from a single region.
Exactly. It's really like a severe economic drought.
That is a perfect analogy. When the rain suddenly stops, you immediately see which farms built reservoirs and which just, crossed their fingers and hoped for good weather. The agricultural sector is now sharply divided by that exact metric.
Right. And the analysis categorizes this repricing into two very different profiles. The ones without the reservoirs, those are the exposed assets. They rely entirely on single-source imported inputs.
And they have zero control over what happens to their crops once they leave the farm gate.
Exactly. But the resilient assets, they survive because they control the downstream supply chain, meaning they own the processing or the transport, and they have highly diversified where they get their inputs.
So if one supplier spikes their prices, they just pivot to another.
Precisely.
But this drought isn't hitting everyone equally. The sources show sub-Saharan Africa is carrying the heaviest burden right now, with median inflation projected to rise from 3.4% to 5%.
Yeah, and Southeast Asia and Latin America are feeling very similar imported inflation pressures.
Okay, but here is where I want to push back. If borrowing costs, energy, and fertilizer are all skyrocketing everywhere, why on earth would you put your money into agriculture right now? Shouldn't investors just run in the opposite direction?
It seems like the logical move, right? But that ignores how food prices actually work. The food price index recently went up 2.4%.
Right.
If you are one of those structurally resilient producers with the reservoirs, your production costs are somewhat insulated from the chaos. So when global food prices go up, you actually capture all that extra output price upside.
So while the exposed competitors are getting crushed because it costs them more to grow the food than they can sell it for, what the finance world calls margin compression, the resilient guys are actually expanding their margins.
Precisely. They have incredible pricing power. But here is the catch. Building that kind of resilient, diversified infrastructure is incredibly expensive. Private investors usually cannot replicate this resilience on their own. They really need development finance institutions, or DFIs, to step in.
And the scale of this intervention is massive. We are looking at the World Bank Group pledging $9 billion annually.
Yeah.
And the International Fund for Agricultural Development is directing 60% of its core financing specifically to Africa. But how exactly does this money act as a lifeline? The sources mention a structural mechanism called junior tranche positioning. What does that actually mean?
Think of junior tranche positioning as, well, a financial shock absorber. Usually when a project fails, everyone who lent money takes a hit. But with this structure, the DFI puts in concessional capital, basically money with more flexible forgiving terms, and agrees to take the first loss in the junior position.
Oh, so if the farm's input costs spike and they lose money, the DFI absorbs that blow first.
Exactly. It protects the regular commercial lenders, it keeps the project safe and bankable for private investors, even when input costs are wildly volatile.
Okay, so if I'm a business sponsor, this shock absorber sounds amazing. Why isn't everyone grabbing this capital? The data shows a massive bottleneck. Out of 91 recent agribusiness projects reviewed, only 14 successfully deployed risk capital.
Yeah, with an average deal size of $57.6 million.
So why so few?
The failure to secure this capital is rarely a question of the money not being available. The true bottleneck is red tape. sponsors frequently fail to meet strict DFI readiness standards. We are talking about precise governance documentation, proven impact pathways, and rigorous debt service coverage ratios, which is really just proving you generate enough cash to comfortably pay back your debt.
So the institutions want to see the detailed blueprints for the reservoir before they help you build it.
Exactly. They require rigorous structural alignment before they will approve that crucial concessional capital.
So the ultimate takeaway for you listening is that in the current landscape of global food security, financial structures and blended capital stacks are just as vital to survival as rain and soil.
Which leaves us with a critical strategic question to ponder. As these wild swings in input costs become a permanent fixture, how will investment committee thresholds for agricultural transactions adapt in emerging markets? Can they evolve to ensure concessional capital is deployed fast enough to prevent a wider food crisis?
Definitely something to chew on. This has been Delphos Insights. Learn more at delphos.co.